Americans are now paying noticeably more for Japanese cars like Toyota, Honda, and Nissan. The reason? A new 25% tax the US government has placed on car parts coming from Japan, especially in the electric vehicle sector. This extra cost has made Japanese vehicles less competitive in the market, and as a result, sales have dropped by about 7% in the first few months of 2025. Meanwhile, American car makers like Ford and General Motors are gaining ground. They're benefiting from government policies designed to give them an edge, which is helping them attract more buyers. But this price hike isn't just affecting shoppers, it's also putting serious strain on Japanese car companies. Their profits are falling, and it's getting more expensive for them to build cars. Japan isn't just talking tough in response, they're taking real action by selling off large amounts of US government bonds. Japan holds over $1.1 trillion in US debt, making it one of America's biggest lenders. In February 2025 alone, Japan sold $30 billion worth of those bonds. That move weakened the US dollar and pushed up interest rates, making it more expensive for Americans to borrow money. It's a bold strategy that puts financial pressure directly on the US economy. At the same time, Japan is shifting where it makes cars. Instead of building them in the US, they're moving more production to countries like Mexico and others in Southeast Asia. These places have lower labor costs and aren't affected by the same tariffs. Toyota and Honda are putting big investments into these regions so they can keep selling to the US without taking a hit from American taxes. This shift doesn't just affect car sales, it's also causing global investors to think twice about buying US bonds, especially as Japan starts pulling back from that market. If one of America's top lenders is moving away, others might start to worry too. If the situation keeps getting worse, Japan may respond with stronger measures. One possible step? Holding back on exports of high-tech parts, especially solid-state batteries, which are key to the future of electric vehicles. Japan is leading the charge in this technology, with companies like Toyota and Honda at the front. If Japan stops sending these batteries to the US, it could seriously slow down the growth of electric cars in America. Japan could also place higher taxes on goods it imports from the US, targeting everything from electronics to farm products. That would hit American industries hard and make everyday items more expensive in Japan. Still, while tensions with the US are rising, Japan isn't putting all its eggs in one basket. They're strengthening trade ties with the European Union and building new partnerships around the world. By doing this, Japan is reducing its dependence on the US and creating fresh opportunities for its car industry and other exports in global markets. This ongoing trade struggle isn't just about cars or taxes. It's about two major economies using every tool they have, from tariffs to tech, to protect their interests and shape the future of global trade. Things are shifting fast in the world of money and trade, and Japan is right in the middle of the action. While the US keeps raising taxes on imported goods, especially cars, Japan is turning to other global partners to keep business booming. One of the biggest moves? Teaming up with the European Union. They've signed new trade deals that not only open up fresh markets for Japanese companies, but also protect them if the US decides to raise tariffs even higher. At the same time, Japan is ramping up the production of electric vehicles in Europe. By doing that, they're staying competitive and keeping up with global demand, all while dodging those expensive US trade policies. The EU isn't just a customer, it's helping Japan push forward with electric car technology, making sure they stay on the cutting edge as the world moves away from gas-powered vehicles. But here's the bigger picture. It's not just about cars or even just about Japan. Something much larger is happening in the global economy. Since the end of 2024, countries like Japan, the UK, Saudi Arabia, and India have started pulling back from the US financial system. They're selling off US government bonds, cutting their investments in dollars, and shifting their focus toward gold and their own local currencies. And it's not just a few countries. 16 of the world's 20 biggest economies are moving away from the dollar. This isn't some short-term dip. This looks like a long-term strategy. Japan, which holds more US debt than any other country, sold over $27 billion worth in just 1 month. The UK sold even more. Saudi Arabia isn't just dropping bonds either. They're loading up on gold. Why is everyone doing this? Because they're worried. Inflation in the US stayed high throughout 2024, and countries are starting to lose faith in the dollar. When the dollar loses value, everything tied to it loses value too, including the bonds and savings other countries are holding. Gold, on the other hand, doesn't work like that. It holds its value, even when inflation rises. So now, countries are treating gold like a safer, more stable place to store their wealth. This trend could have major consequences. If fewer countries want to use the dollar or invest in the US, it could lead to higher interest rates, slower economic growth, and bigger financial problems in the future. Whether the US changes course or continues to stick to its current path remains to be seen. But what's clear is that Japan and many others are preparing for a world where the dollar isn't king anymore. For a long time, the United States had a lot of power in the global money game. If a country stepped out of line, the US could hit them with financial penalties, basically freezing them out of the system. That's what happened to places like Russia, Iran, and Venezuela. They depended heavily on the US dollar and the global banks that ran through it, which made them easy to target. Now, countries are getting tired of playing by rules they didn't write. They're looking for ways to break free from that kind of control. Step by step, they're building something new, a way to do business and move money without having to rely on the US dollar or its financial systems. It's not just talk. Countries are making big changes. Instead of using dollars to trade with each other, they're starting to use their own money. China and Russia, for example, have cut their use of the dollar by almost half in just 2 years. India and Iran now handle energy deals using rupees. Japan is telling its businesses to use yen more often in trade. This shift means the dollar isn't the only option anymore, and the more countries that join in, the weaker the dollar's hold becomes. At the same time, gold is making a huge comeback. Countries are buying it like never before. In 2024, China picked up over 150 tons of it, breaking records. Poland, Turkey, and India are doing the same. Why gold? Because it doesn't get weaker when inflation rises or economies stumble. Unlike paper money, gold has a reputation for holding its value, no matter what's going on in the world. Alongside these changes, countries are building their own systems to send and receive money internationally. Russia created SPFS, a system that lets banks talk to each other without needing approval from US-based networks. China built CIPS, which allows cross-border payments in yuan. The BRICS group, Brazil, Russia, India, China, and South Africa, is even talking about launching their own shared currency. These new tools make it easier to trade and invest without ever touching the US financial network. And it's not just the money world that's shifting. Even countries like Canada are rethinking old habits. For decades, Canada sold almost all of its oil to the US, over 98% of it. The two countries were neighbors, the pipelines were already in place, and the relationship seemed unshakable. But things are changing. New US trade rules are unpredictable. A few years ago, Canada was hit with big taxes on steel and aluminum. Oil wasn't affected at the time, but the fear is still there. What if next time energy gets targeted? That risk has Canada looking for new partners. Meanwhile, Asia is hungry for energy. China's oil needs are expected to more than double by 2040. India's demand is climbing fast too. For Canada, that means there's a big opportunity if they can get their oil to those markets. To do that, Canada is working on major projects like expanding the Trans Mountain Pipeline. When it's finished, it'll move nearly 900,000 barrels of oil per day straight to the Pacific coast. From there, it can be shipped directly to Asia. The project has been expensive. Costs have jumped from $5 billion to over $21 billion. But the long-term goal is clear: less dependence on the US and more flexibility in global markets. Canada's also investing in liquefied natural gas facilities so it can ship energy overseas more easily. These changes won't happen overnight, but they show a clear trend. Countries all over the world are moving away from relying on the US, on its money, its banks, and its markets. They're building new paths forward, and each step makes the old system just a little less central. Why does that matter? Because right now, the US dominates the world's LNG exports. But Canada is stepping up, determined to grab a slice of that market. Countries like Japan and South Korea import most of their energy from overseas, more than 80% in fact, and they're actively looking for new, reliable suppliers. They want energy they can count on, especially with so much uncertainty in the Middle East and with Russia. Canada, with its political stability and strong infrastructure, is pitching itself as the dependable partner they've been looking for. This isn't just about making money. It's about shifting the balance in the global energy game. Canada is no longer just following the lead of big energy players, it's becoming one of them. These new investments aren't just building pipelines and terminals, they're building long-term relationships and securing decades-long trade deals that could change who controls the flow of energy around the world. But here's the twist. This move doesn't just affect Canada, it sends ripples through the United States as well. Right now, over half of the oil the US imports comes from Canada. That steady flow helps keep gas prices more stable at home. But if Canada starts sending more of its oil and gas across the Pacific, American refineries might have to shop elsewhere. And that shopping trip could get expensive, possibly adding up to $10 more per barrel. That cost would likely show up at gas stations across the country. There's also a bigger picture here: power and influence. For years, the US had a lot of say over how Canadian energy moved and where it went. But if Canada locks in long-term deals with Asia, Washington's influence could shrink. And that shift comes at a tricky time. Experts believe the US might soon become a net importer of oil again by 2030. If that happens and Canada's barrels are already booked for Tokyo or Seoul, the US could find itself scrambling for alternatives. So what's next? Will the US work to strengthen its energy ties with Canada and offer better terms? Or will it put up new trade walls to try and slow down Canada's pivot toward Asia? Either way, big decisions are coming, and they'll affect everything from pump prices to energy security across North America. Meanwhile, there's another story unfolding that's just as important. This one about money, not oil. Japan and China, two of the biggest holders of US debt, are pulling back in a big way. They've started selling off US government bonds, which used to be one of the safest places to park money. So why the change? Let's take Japan, for example. In October 2024, it sold more than $20 billion in US treasuries. A big reason? The Japanese yen took a nosedive in value, hitting its lowest point in decades. To stop the slide, Japan had to step in, buying back yen to boost its strength, and to do that, they sold off US debt. It was a quick move to protect their currency, but it also revealed something deeper. Japan is thinking long-term. Instead of stacking up US bonds, it's choosing to invest in its own future, upgrading infrastructure, boosting technology, and building strong local industries. Holding on to US debt just doesn't fit that plan anymore. This isn't just about reacting to a crisis, it's about shifting priorities for the long haul. China is on a similar path. It's also trimming its US bond holdings and looking for other ways to store value, like increasing gold reserves or investing in regional partnerships. Both nations are signaling that they don't want to be too tied to the dollar, especially with rising interest rates, ballooning US debt, and inflation still hanging around. This change raises some big questions. What happens if more countries follow suit? If major financial players stop trusting US bonds, where will the world put its money instead? Is gold the new safe bet? Could other currencies rise to challenge the dollar's dominance? No one has all the answers yet, but one thing's for sure: the old systems are shifting. Whether it's oil heading east or money heading out of US bonds, countries around the world are making bold moves to protect their futures, and that's reshaping the global economy in real time. Something big is happening behind the scenes of the global economy, and it's not just one country making moves. Japan and China, two of the largest economies in the world, are quietly rewriting the rules. Both are stepping away from the US dollar and making changes that could seriously shake things up for America and beyond. Let's talk numbers. A decade ago, China held more than $1.2 trillion in U.S. government debt. By the end of 2024, that number dropped to under $800 billion, its lowest point in over 10 years. And it's not just because they felt like switching things up. China has been shifting its money into gold and other markets as trade tensions with the U.S. keep heating up. They don't want to rely too heavily on the dollar anymore. And that decision could change the way the world's money system works. Now, why does this matter? Because the U.S. relies on countries like China and Japan to buy its government bonds. These bonds are how the U.S. funds everything from schools and roads to national defense. When fewer countries want to buy those bonds, the U.S. has to offer higher interest rates to attract other investors. That means the government has to spend more just to pay back what it owes. And with national debt already past $34 trillion, that gets expensive fast. It's not just the government that feels the pressure. If interest rates go up, borrowing becomes more expensive for everyone. That includes businesses trying to grow and families taking out mortgages or loans. Suddenly, everyday life costs more, and the country has less money to spend on things people actually need, like healthcare or education. Japan is playing a similar game. They used to be one of the biggest investors in U.S. debt, but now they're selling off too. In late 2024, Japan offloaded more than $20 billion in U.S. bonds. Why? The Japanese yen was crashing in value, so the government had to step in to stop it from falling even further. They sold U.S. bonds and used the cash to buy yen, trying to keep their own economy stable. But that move also shows a deeper shift. Japan, like China, is now focused on investing at home, building up infrastructure, tech, and key industries, rather than holding piles of American debt. If these trends continue, other countries could follow. And if that happens, the U.S. might not be able to count on cheap, easy borrowing the way it used to. What comes next could be higher taxes, cuts in public services, or bigger financial struggles for regular Americans. And here's where politics enters the mix. If Donald Trump returns to the White House, the dynamic could shift again. During his previous term, Trump took a tough stance on Japan and China, calling out what he saw as unfair trade practices and putting up trade barriers to protect U.S. industries. If he's back in charge, he might pressure Japan to keep buying U.S. bonds, but that only works if Japan agrees. And if America keeps moving toward protectionism, Japan may lean further into building partnerships with China, Europe, or other Asian neighbors instead. So, can the U.S. learn to rely less on Japan and China? Will Washington find new investors or face the consequences of this financial shift? These aren't just numbers on a spreadsheet. They're real-world changes that could affect how the U.S. economy works for years to come. And while all this is unfolding, Canada is quietly making a game-changing move of its own. After decades of sending most of its oil to the U.S., Canada is turning to China. That's right. One of America's closest neighbors is shifting a huge part of its energy trade to Asia. Why? One big reason is the Trans Mountain Pipeline expansion. Canada is spending over $24 billion to triple the pipeline's capacity, taking it from 300,000 barrels a day to nearly 900,000. Once it's finished, that oil doesn't have to go south through the U.S. It can go west, straight to the Pacific, and from there directly to China and other Asian markets. China's booming energy demand makes it the perfect customer. But this isn't just a one-time deal. It's a strategic move. China is building refineries and port systems specifically to handle Canadian oil, setting the stage for a long-term partnership. This goes beyond trade. It's a geopolitical shift. Canada and China are tying their economies together, and that changes how global power is distributed. This move could seriously disrupt the energy market. The U.S. used to get about 60% of its imported oil from Canada, a reliable nearby source. If that supply starts heading to Asia instead, the U.S. may be forced to turn to more expensive or unstable suppliers. That means higher costs for refineries, pricier gas for consumers, and a more fragile energy supply chain. U.S. policymakers will have to adapt fast. They may try to find new energy partners, boost domestic production, or change trade policies. Either way, the pressure is on. The U.S. risks losing a key piece of its energy security, and its influence in the global energy market. Meanwhile, Canada is stepping up, no longer just a quiet supplier next door, but a serious global player. This bold move puts Canada at the center of a new energy network stretching across the Pacific. And it's not just about selling oil, it's about building alliances, shaping the future of trade, and showing that the world no longer revolves around one country's economy. As Japan, China, and Canada all shift their strategies, the global balance of power is tilting. The US can either adjust or risk falling behind in a rapidly changing world. So what do you think? Are we watching the start of a new chapter in global trade and finance? Or is this just a bump in the road? One thing's certain, the rules are changing and the whole world is paying attention.